Hi, and welcome back to Small Caps. My name is Jess Furtick, and today I have the absolute pleasure of welcoming back Alex Scanlon, who is the Managing Director of Barton Gold Limited. The AISC ticker code is BGD. Hi, Alex. It's good to have you back on the show with us.
Hi, Jess. Good to be back.
Alex, it's been such a long time between interviews, and there's been quite a lot of progress that the company has made. So let's just dive straight in. The company's recently announced a really impressive updated JORC resource. Can you tell us what were the contributing factors for that updated JORC resource?
So last year we ran an initial scoping study to test essentially the economics of development at scale at our Tunkillia project. And so the idea here is we were trying to figure out if we fix the assumption of 5 million ton per annum, solve for CapEx, solve for OpEx, solve for mine design, does this give us or does this validate our expectation that economies of scale, both in capital and operating costs, will deliver a very interesting project? And the answer is yes. So the initial scoping study demonstrated that we could produce around 130,000 ounces of gold per annum, and then all-in sustaining costs around 1,900 Australian. So it's just in the bottom quartile of global producers on a current cost curve. But when we were doing that, we actually, in the pit optimizations, we actually ran into the bottom of the wireframe of the block model. So that was actually a little bit surprising. We did a pit optimization at 3,500 Australian dollar gold. So we did some additional drilling below the main pit area and basically opened up the block model and extended the resources to depth. And then what that will do is set up for what is now our optimized scoping study and allow us to expand the optimized block model, or they expand the optimized pit design. We're still running the same pit constraint at 3,500 Australian dollar gold. The idea is to be able to compare an apples for apples comparison between the two studies and show the efficiencies that we brought into it. But we quite literally had to de-restrict the block model.
Okay, and Alex, you also announced an inferred silver resource update as well of 3.1 million ounces. How will that contribute to the project's economics and development strategy?
So the idea with the silver is essentially to formalize a body of mineralization that we knew was contained within the deposit. So from an operating standpoint, silver, of course, has a ratio value per ounce with gold, somewhere in the order of 80-1. So when we think about the annual production profile that we've modeled, it's around 130,000 ounces of gold and 300,000 ounces of silver. Now, the silver, albeit large, is actually a relatively small proportion of the ongoing annual economics. But by formalizing this, by bringing it into JORC resource, and we will come back and later upgrade that later this year with some additional assaying, it allows us to actually look at that as a financial stream inside of the model that as we move towards development, we can actually leverage that to bring that cash flow forward and use that to fund or co-fund the development of the project. So it's really kind of a financial leverage tool that we can extract from the project and bring forward.
Yeah, Alexander, it certainly helps. Obviously gold's had a rally, but we're seeing silver having a rally as well. So you're in the right commodities for sure. You just mentioned before an optimized scoping study. Can you tell our small caps audience just a little bit more about what that is, what you guys are doing, and why it's really important in terms of the development of this project?
So the initial scoping study that I just talked about, again, was really designed to test the project in a sense. So all projects are essentially a series or a system of equations. So you have to sort of start by fixing an assumption somewhere, solve for all of these things, and then you can start playing with optimization. Our approach to that study was to take some very conservative assumptions around the nature of the material and the manner in which you would process the material. And the intention there was essentially to sort of make the project, see how it would work with some less than favorable assumptions. And it gave us this bottom quartile number. So when we look at that all-in sustaining cost, there are a few really important conservative assumptions that we've made in there. We have assumed, for the purposes of that initial test, that the material has a hardness that is much, much higher than its true hardness. So it has a bond ball mill work index, so a measure of how much energy required to grind the rock into dust. The material has a bond ball mill work index of between 15 and 21. But we assumed that all of the material had a work index of 26.5. 26.5 is among the hardest material processed in Australia. So we essentially inflated the hardness of the material. And then we said we take this very, very hard material and we put it in only a single stage crush. So we crush it to 150 millimeters, so about the size of a bowling ball, basically. And we put that in a giant, oversized, overpowered sag mill, and we tumble that all the way down to 75 microns or 75 one-thousandths of a centimeter. So the idea here is we found one of the most energy consuming ways to grind excessively hard material. Now, as we come back and we start to relax these assumptions with this optimization, we know where, having solved this, where we can tune various aspects of the comminution circuit. So we've actually gone and done very intensive trade-off analyses between different circuit models, different grind sizes, different materials. And what we know now, given the actual hardness and the additional work we've done, is that we'll probably end up reducing our energy consumption by anywhere from 20 to 35 or 40%. And that will have a really significant impact to take that already low all-in sustaining cost and bring that down. What that means is we can use some of those savings to lock in the additional capital components to essentially crystallize that efficiency in the crushing and grinding. But then we can take the rest of those savings and push them out into the mine design and smooth out that pit shape, extend the life of the project, and then also start to play with some efficiencies. So that's even thinking about the difference between oxide and fresh material. Oxide material, of course, is softer material. It's partially weathered and broken down by nature. This oxide material will actually go through the mill faster. It has higher recoveries. So now that we've done all of this, we can really start to play with some of the finer tools. And what we expect is that this will basically demonstrate to us in a couple of months when we release our updated study, a very, very compelling, long-term, large-scale gold producer. And one of the most important aspects when we think about project development, because this is being designed to actually be delivered instead of sort of be sold, if you will. When we think about reducing energy consumption, it's not just a matter of reducing your cost, today, so to speak, but first of all, we're reducing the amount of energy we're consuming to turn rock into dust. So that in unto itself must be a good thing. And all else equal, you'd rather consume less rather than more energy and not just gratuitously waste money, whether it's profitable or not. But energy is one of the biggest risks inside of any mining project. So people think a great deal about the forward price of a commodity. What is sometimes missed is the forward price of your inputs. And people focus on labor costs a lot, but energy prices can move dramatically and suddenly. And so you can be in a situation where you might have a strong commodity price, but your energy input cost spikes dramatically. And all of a sudden you've hollowed out your entire profit. Gold is thankfully in a very strong position where on a forward basis, we can forward sell, we can swap gold for energy and lock in essentially the key commodity price spread between, the key output and the key input. But in a manner of speaking, if you can reduce your risk and volatility inside of a project, you should do that. By reducing energy, also by looking at converting to a mixed sort of microgrid renewable and liquids solution, we're essentially significantly reducing the amount of liquid energy we will be consuming throughout the project life. We're capitalizing or fixing the cost of that during the project life for something like 50, 60, 70% of the energy consumed, which means we've hedged our energy price for the life of the project. So the predictability and the stability of your energy price is a great, great comfort when you're thinking about actually building this and then operating it and being able to sort of count on those cash flows and create a reliable, steady dividend stream.
So in a nutshell, a very, very important study to complete for the company in terms of cost savings, efficiencies, and as you said, that sustainability piece, across the life cycle of the project, but also, that can weather commodity cycle storms, which is, so important in this game. Now, talking about money, so the company has just announced a $3.1 million profit in the December half year. How sustainable is, that sort of cash coming in, considering all of the exploration that the company is doing? Tell us a little bit more about how that profit came about. And congratulations.
Thank you. So that definitely, I think, caught a few people by surprise. Obviously, we are a we are considered by the market, or we occupy a portion of the market that would be generally considered sort of, junior explorer developer companies. In reality, we're much more of an asset manager that happens to sort of appear as an explorer developer. So we have quite a great deal of existing infrastructure. We have above ground stockpiles, we have equipment, we have camps, villages, all sorts of facilities. And one of the things that we do that not only in terms of having these assets, which give us a huge head start when we want to start operations, is we actively leverage them. So when you think about, targeting growth in your future portfolio of projects, you think about using your current project today to fund project tomorrow. We use the assets as we have them today to essentially co-fund the preparation and basically transition to operations of those same assets. So we have been running for the past 3 or so years really active asset management and monetization programs. And what I mean by this is we have gone through our site and continue to do this. We've produced around $15 million, I think, in revenues, looking at basically preparing and selling gold concentrates, selling surplus equipment, processing and selling scrap metals. We make very good use of tax and grant programs. And we rent our camps and facilities to both private and government entities operating in the region. So we actually have the longest private airstrip in central South Australia there, which is quite useful for very, very large aircraft. So this is something where we generate every year typically $3 to $4 million per year in just steady internal additional cash. So that 15 million in revenue produced about 12 million sort of profit in isolation there. So $12 million net additional cash over the past 3 years. And as it happened this year past, or this half year past, we actually also prepared and sold. So we prepared and sold about $5 million worth of gold. Prepared gold concentrates. We market and trade those ourselves, had them processed, refined, and sold the gold. And then we also had a rather large ATO R&D tax refund of about $2.4 million. So this all came together during the half to actually overcome the very extensive technical work that we're doing. And we expense all of our technical work, so we don't capitalize any of it. So it was $8.5 million of revenue, overcoming about, $5.5 million in ongoing technical work for the half year. So it was a nice surprise. And I think the key takeaway is that people can expect us to continue pursuing these programs. It's really, I think the takeaway is there is sort of an indication of a different approach by sort of a different team aiming towards an actual sort of long-term commercial objective. When fundamentally, it's all about making these next steps, adding this value, and making this transition into operations with the smallest amount of dilution possible, because we want today's shareholders to be the prime beneficiaries of tomorrow's success.
That's so interesting, Alex. And I'm not surprised shareholders were surprised by the profit that you reported for your half year, given you are a junior, explorer developer. But it's really impressive to see sort of that prudent and strategic sourcing and use of funding, or sourcing of funds coming into the company. It's not it's not usual. It's quite unusual for a junior resources company. So well done. That's really excellent, and shows that management can execute, and that you do look after shareholders. You don't want to have that dilutionary aspect. You're looking at lots of different ways to minimize that. So that's a huge positive. Now, I just wanted to pivot a little bit and talk about your Central Gawler Mill restart, and how that will kind of how that's critical to Barton's target strategy, and what the key risks are of that project as well.
So if we think about, I guess, the theory of the mill, right? So we have the mill itself. When we bought all of these assets, our view of the world looking forward, and we started doing the work on these assets in 2017 and 2018. And the view was that we wanted to build a long-term, large-scale exposure to gold in a tier 1 jurisdiction, preferably with ownership of our own infrastructure. When we bought all these assets, we had the opportunity to say, turn on this existing mill that we have that had been quite recently running, and just start small-scale operations again. But we took the view that, one, we don't think that gold is properly priced in the then current market. We had a view that, sadly, many of the things we now see happening would be happening. So we took the view we wanted to step back and actually build a much larger sort of destination in terms of production scale, right? So if we think about producing 20 or 30 or 40,000 ounces, that is not nothing. It's, you know, it can be a very attractive proposition, particularly if you already own your infrastructure. But the difference between a 40 or 50,000 ounce per annum company and a 150,000 ounce per annum company is not a threefold factor in valuation. It's probably more like a 5 to 10-fold factor in valuation. So we wanted to create that destination of scale and consequence. And that's why we focused on that Tunkillia project that we talked about. We had a strong suspicion that the geometry of the mineralization there would present this really attractive, highly efficient and fast payback model. So that's something we've set to lock in there. But we also suspected that the sort of the endowment there along the mineralized strike was larger than it was previously thought to be. So we've now tripled that. So that's now all come together, and we've put that in a position to essentially move that into a commercialization pathway. So this study will essentially kind of put the box and bow on it, and then it will go through your standard mining lease environmentals and approvals and all of these things. Now we're shifting our attention back to that mill. And we've been sort of very quiet about it for a number of reasons, because again, focusing on destination, but the mill represents a leverage point for us, not only to the mineralization that may have gone through that mill in the past and mineralization in our sort of stage one area that we can put through it, but now having created a destination of consequence, the restart of that mill does not represent 20 or 40,000 ounces. It represents a pathway to 150,000 ounces. So we're not coming back to this. We actually have been thinking about this for a couple of years. The gold that we sold last year was a concentrate produced from our disassembly of the gravity circuit on the mill, because we were getting ready basically to redesign the gravity circuit to make it even more efficient. So we come back to this. We are now doing a number of studies to evaluate in what format do we want to restart that mill. We have come out about 2 weeks ago and said that we are targeting to have that running during 2026, so indicatively in the middle of 2026. So this is the first time we've kind of been willing to say that. And yeah, it becomes very important because in simple terms, in all else equal, if I have mineralization, we'll take our Tarcoola open pit Perseverance mine. We have 20,000 ounces in the pit floor there. We've done some more drilling. We have yet to upgrade those resources. If I say those resources have gone through the mill in 2017 and 2018, so we know how it handles. We have proven logistics, proven metallurgy, proven infrastructure. If I did not have that mill and I had to come up with some kind of processing solution, I'm going to be spending anywhere between $50 and $250 million for that solution. Having that mill and being able to take a really low cost, low risk transition into operations represents a very low risk adjusted step into a high value transition from, let's say, explorer developer up to producer. So it's a leverage point for us. And that is where we're going to be focusing on doing that. We're going to be going and upgrading the Tarcoola resources. We're going to be looking at how we can get that mill running very simply. And then the initiation of that operation will essentially mark the start of a 15-year production and growth and development pathway, starting first with material going through that mill, and then the development and expansion into our Tunkillia project a few years later.
Thanks, Alex. And so how does the company plan to kind of prioritize expenditure, between the mill and then Tunkillia?
Yeah, so good question. The opportunity that we saw several years ago was, again, focus on the future and then leverage the existing infrastructure to pay for the future, right? So again, staged, low cost, low risk, and ultimately, we believe much, much lower dilution. So the idea that you've got a relatively small hurdle to get over at the mill in terms of capital cost means that we can focus our capital on that for the time being. And then when you're generating free cash flow for that, it actually starts to pay for all of these other costs that are going on with Tunkillia, right? So if we think about the studies pathway and the engineering pathway for Tunkillia versus an ongoing operation at our existing mill, if our existing mill is just producing 20,000 ounces per annum for the next 2 or 3 years, and let's say, for sake of assumption, that we can do that for less than 2,000 Australian dollars, today's gold price, which is getting very near to $5,000. Let's say it's $4,500 gold. We could be making a $2,500 per ounce gross margin or roughly 40 to $50 million annual gross free cash. So we have income that pays for all of Tunkillia's activities, sort of off the top in a current basis, and we're putting away savings to actually then pay for the equity cost of building Tunkillia. So it's actually a very small piece of capital that then pays for the whole thing and actually sort of pays for both sides of it.
So again, super strategic, efficient uses of capital, and non-dilutionary, or as little dilution as possible for shareholders. That's your strategy.
Mm-hmm. Exactly.
Alex. Now, I know we've covered a lot, so I just have one more question for you, and that is just to give our audience, 2 to 3 key takeaways as to why, Barton Gold should be their next investment.
Well, I think we've touched upon 3 sort of key aspects that I really think right now is a very, very interesting time to be looking at us. One, when you look back across our history, what you can see quite clearly is a very, very strongly responsible management of your capital. And I sort of not so jokingly say to people when I say, come have a chat with us, is that, come meet the team who works as hard for your investment as you did. We treat the responsibility of essentially being the asset managers or the custodians of people's investment very, very seriously. And importantly, we are also the largest investors. So we're perfectly aligned in that respect. That track record of performance, might indicate how, responsible we'll be with your capital going forward. And we are at a very interesting transition point, so point number 2. We have, through a very difficult gold market, managed to do all of this with very, very little net capital consumption. And we are now actually at this point where we're saying, hey, we are now going to transition towards operations. And these are usually very interesting periods of times for companies. The fact that we can do that cheaply might suggest that we have a producer sort of valuation target, or will occupy this space, and we can get there with a relatively short, simple, and importantly, low risk step. The third point behind that is we are not making a transition into small scale operations. We have predefined a destination of scale. So when we start producing 20,000 ounces, what we have is 150,000 ounces coming up behind it. And that makes that transition point, sort of number 2, all the more important and valuable. So I think it's a very, very interesting time to have a look at us.
So interesting, Alex. Thank you so much for that summary. I just wanted to hone into this point that it's so interesting that you really built this kind of revenue model, and or strategy to having efficiencies with funding during a very difficult gold market, which actually makes such a robust business that can survive in commodity cycle dips. It's just amazing that the company is, doing so well and generating cash flows, in a time of a gold boom, but it can still survive. And management's very prudent with its costs and, with strategic with funding. And I think that, that speaks volumes. So well done, Alex. I think that's really exciting and great to have you on the show. And really looking forward to you coming back and giving us more updates on what's happening. Producing next, hopefully, maybe, or the scoping study. Still.
At least on the clear path with all the numbers laid out and just marching towards it. Yeah, absolutely.
On the pathway. Brilliant, Alex. We'll take care and we'll chat to you soon.
Thank you.